Hey everyone, Couch Investor back to another video for today. So let's go over Sea Limited's earnings report. Now, year to date, the stock has done tremendously. Of course, the stock was hit big time after the post-pandemic reaction or so, because the business was slowing down. Each and every profitable metric, let's say, became less profitable, especially the digital entertainment side of the business saw a huge decline after the pandemic. But in more recent quarters, the company has done some good moves to become a bit more profitable. Cost cuts across the board, not growing like crazy in each and every market, closing markets that they barely opened up because they wanted to focus on their core business, their core markets. And it is actually helping. It is actually doing much better today than before. Now, at the time of making this video, the stock is down around 10% or so, although meeting expectations when it comes to revenue. Then with regards to earnings per share, I saw some estimates that were 73 cents. The numbers came in at 15 cents, but that 73 cents might not be that accurate, so I leave it up for a discussion. But overall, I do see some major improvements in that business. That said, there are still some meh numbers there. We're gonna start with a comment from the CEO. So the first quarter of 2023 was another strong quarter for us. The results for the quarter are a testament to our team's commitment and creativity. We have innovated to do more with fewer resources. As I said, this is the theme of the year, doing more with less, while never losing sight of our commitment to our users and never letting our service standards fall. Across our business, we have been focused on maximizing operational efficiency and improving user experiences. And we continue to make meaningful progress on both fronts. We are also pleased with the progress we have made so far to strengthen the fundamentals of our business. As we continue to fine-tune our operations and navigate near-term macro uncertainties, we remain highly confident in the long-term opportunities in our markets and our ability to capture those profitably. And I agree, they are turning this ship around. There's still some way to go, but at least we are seeing some good results right now. Now, before we jump into this report, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, would really appreciate that. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. And for those of you that are waiting for my SoFi video on yesterday's bearish report, stay tuned, we'll be here later today. All right, so total GAAP revenue increased 5% year over year to just over $3 billion. We see some nice improvements here in the e-commerce segment. Then when you look at the digital entertainment side, which is this one right here, a big compression there, big improvement when it comes to the digital finance or Sea Money. Now, with regards to digital entertainment, we've seen the downtrend. I'm going to talk about this in just a second. Then as for adjusted EBITDA, of course, huge increase here. Last year, negative $509 million for the same quarter. Now we're positive $507.2 million. Of course, you have to include the impairment of goodwill, which is a one-time thing, and also stock-based compensation there. But overall, still, this reached positive numbers, which is great. And then when you look at cash and cash equivalents, short-term investments, etc., we bottomed at Q4, $6.9 billion. We're now at $7.2 billion. So you see, the business is becoming more profitable, more operationally beneficial for the underlying business here. Now, when it comes to the e-commerce side of things, so Shopee, 46% growth year over year here from 1.3 to $1.8 billion. When you look at the increase, we see 54% year over year increase in core marketplace revenue and 33% increase year over year in value added services revenue. When you look at adjusted EBITDA, also went from the negative territory in a much more positive ones. The huge increase here you can see from Asia markets adjusted EBITDA, we're at 275.8. Last year, negative 408. The other markets are still negative, but approaching break even. And then when you look at digital entertainment, which again, Garena Free Fire was we'll call it a cash cow for the company during the pandemic. Since then, as you can see, bookings have been coming down, and really there's no end in sight here. Again, decreased 15% quarter over quarter. But when you look at quarterly active users, we might have seen a bottom here. A small increase of 1% quarter over quarter. Remains to be seen if that stays like this, because if next quarter will go down again, not a nice picture. Of course, when you have such a successful game and it's just a one-off, it's not like Fortnite, because Fortnite, they innovate every single week. They have partnerships left, right, and center. The game is still growing. With Garena Free Fire, I feel that it is stagnating and has been stagnating for a while. Although, yes, they do have some partnerships and some announcements, but overall, it's not the same thing. And you can clearly see this by the numbers here. Also, if you look at quarterly paying user ratio, it's down another 1.3%, quarter over quarter, that is. So in my opinion, the market is reacting negatively, not because this was a bad quarter. No, all in all, I think this wasn't a good quarter or okay quarter, all things considered. But because this, which was the most important part of their business, is still deteriorating, I think the market is not liking that very much. Then when you look at C-Money or the digital financial services, this is still increasing pretty fast. So GAAP revenue increased 75% year over year. Of course, when you look at quarter over quarter, growth might be slowing down a little bit. And then when we're reaching these tough year over year comparisons, let's see if this company can still continue to execute and grow as fast as they were before, because this is still a tiny part of their business compared to the e-commerce side, because obviously digital entertainment side has come down as well. So it's close to that one, but overall, this business is majority led by the e-commerce side of things. Then when we look at gross profit, big improvements there, 21% growth year over year to $1.4 billion. So I like what I'm seeing here. And I certainly liked what I'm seeing in the cost and expenses. So cost of revenue is down 6% year over year. Sales and marketing expenses down 60% year over year. When you look at G&A, that's only up 6%. Provision of credit loss, that actually increased quite a lot. So 121% year over year. A little comment on that in a second. And then R&D is down 6% as well. Now, I also want to mention that stock-based compensation did increase year over year as well. Now, when it comes to net income, big surprise here, positive $87.3 million compared to a loss of $580.1 million the same quarter last year. And I do say here that total net income for this quarter was negatively impacted by $117.9 million impairment of goodwill associated with their prior acquisition. Now, with regards to that huge increase in credit loss, so they say here, this is because we're primarily driven by expansion to a broader user base and the growth of our loan book, which they say here non-performing loans past due by more than 90 days as a percentage of our total gross loans receivable remains stable at around 2%. Now, last thing before we conclude this video is the graph. So as you can see here, last time we had earnings, we also had a gap here. And as you can see, we never really filled that tiny gap. This is on the daily chart. Right now, well, at least yesterday, we hit resistance, right? We hit the same point we were back in April, $89, $90 or so, got rejected there, went all the way back down to 73. Now this time, we got there yesterday, got rejected. We also have a gap here at around $80 to $83 or so. Right now, we will open up at that lower endpoint, which means this gap will probably get filled pretty fast. And then it becomes a question of whether or not the 200-day moving average here will become a little support and will build our way back up. Or if you want to look at the weekly chart, the question will be, can we stay over that 200 and that 50-day moving average? Again, we will be filling that gap. We also have a gap on the way down. When you look at RSI, it was a bit at the higher end, still not overbought. We're at 62. When you look at the MACD, was bullish, pretty bullish actually over the zero line. All in all, there is a gap. It will get filled. This quarter proved again that the company can become more profitable, but probably the market wants to see some improvements when it comes to the digital entertainment side of things. Because if that side continues to deteriorate and does not return to it being the cash cow for the business, then yes, you're losing a, let's say, big point of the bull thesis here, right? Because overall, we invested to have the e-commerce side, digital entertainment, and then the fast-growing C-Money. Now, the fast-growing C-Money is already approaching the levels of digital entertainment. If digital entertainment cannot improve, it will become an issue, and I think that's why the market is punishing the company right now. Of course, if they mention something extraordinary during the earnings call, I will pin it in the comments down below. Of course, do share your thoughts as well down in the comments. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.